Hello, the Daniels Investment Group would like to welcome you to the University of Denver. Thank you so much for considering our proposal. In this video, you'll learn a little bit about our team, our investment philosophy, and our unique strategy for finding alpha. This is 4 advisors and 6 students. Advisor and Daniels faculty Trent Ambler directs our investment research with help from Denver investment partner John Tessio and faculty members Jean-Philippe Tremblay and Tommy Johnson. Investment philosophy originates from the assumption that equity markets are inefficient and that not all equity securities are properly priced. We believe that a firm's capacity to generate value for its owners is the most important measure when assessing a stock's true value. Based on this assumption, our quantitative model employs factors of value that help us identify equities that are overvalued or undervalued given their relative ability to return value. Further, we hold that relative mispricings are most prevalent amongst certain defined market segments and investment groups, and that by focusing our efforts on these segments, it's possible to outperform. We also support the 1990s research reports by authors Jagadish, Titman, and Asnis that found that underperforming stocks tend to continue to underperform, and outperforming stocks tend to continue to outperforming in the short term. From this assumption, we identified factors of momentum that help us identify recent losers and winners that may continue to lose or win. Asnis later concluded that these two factors, momentum and value, are inversely related, and that value strategies tend to work best among low momentum loser stocks, and vice versa. His conclusion is the foundation of our quantitative funds investment philosophy and our model. Our philosophy maintains that the majority of our alpha and return achieved on our portfolio will come from our model's ability to find market-neutral return using value momentum factors. But we also believe that there is an opportunity to generate outsized returns by making sector-focused investments. This belief stems from the dynamism and high dispersion of returns in certain sectors and led us to take both long and short positions in 2 of the Dow Jones 11 sectors. Our philosophy has been constructed with the guidelines of the CQA challenge in mind, and that our model is designed to outperform a cash benchmark over the next 5 months, and will still be keeping within our beta, market, and capital constraints. We stand behind our unique philosophy to earn outsized returns regardless of market conditions, and are eager to see where the next 5 months takes us.
We broadly define risk as the potential for deviation from an expected outcome. This definition can be applied within a portfolio management context through a process that uses past variance drivers to extrapolate future expected risk. Specifically, we apply mean variance optimization techniques in the management of our risk exposures. We seek to manage our exposures both formally through the use of an optimizer and less formally through various risk budgeting exercises. Either way, we look to align our risks with our investment philosophy and expected risk-adjusted return.
So when evaluating sectors for potential informational asymmetries, we emphasize return dispersions, constituent counts, and unique sector-specific insights of our investment team. The return dispersions were evaluated using sector-level Winsorized monthly returns over a 16-year time period. Our investment philosophy states that there are pockets of inefficiency within the market created by behavioral biases of human investor decisions. This creates an opportunity to build a sector-specific alpha model using factors designed to capture excess returns from undervalued and oversold stocks. Our philosophy has maximum effect within chosen sectors for a variety of reasons. Generally, expectational errors for companies tend to generate surprises with regard to operating performance and therefore moves in the market price. In our view, this causes investors to become overly optimistic about growth and overly pessimistic with regard to value, creating inefficiencies in pricing. This idea is especially pertinent within healthcare and IT, as growth companies are widely rewarded with higher prices and value is sometimes overlooked. Empirically, these sectors have the highest return dispersions and hold a sufficient number of issues that we have confidence in the ability of our model to capture any information asymmetries that exist.
Portfolio construction decisions are handled according to a quantitative investment model. We employ the S&P backtester software and a CompuStat financial database to build our models and to generate buy and sell signals within our universe. The models developed by our team sort the Russell 1000 index into quintiles and apply proprietary factors to generate the expected alphas for the securities. We apply distinct long and short models for each market segment that we invest in. The long model follows a value-based strategy looking to capture undervalued securities. The short model follows an inverse momentum and value strategy, utilizing Asmus's inverse value and momentum theory. The models were developed specifically for two sectors, information technology and healthcare, both equally weighted. Should we suspect that the portfolio is unreasonably over or underweight, we reserve the right to adjust the holdings per our discretion. The portfolio contains 30 long and 30 short holdings with 10 million invested in each model. The number of holdings may vary on a monthly basis though. Each individual security is equally weighted within the portfolio and the individual positions of no more than 5% of the overall portfolio. The portfolio is rebalanced monthly and monitored daily in an effort to maintain compliance with the portfolio's beta and dollar neutrality requirements. We base our buy and sell decisions on the expected alphas generated from our model, with new scores generated monthly. Outside of managing portfolio constraints, desired exposures, and potential blowups, we rely solely on our model to generate buy and sell signals.
In order to capture alpha and take advantage of the market inefficiencies created by behavioral biases, we have constructed 4 separate models, a long and short in healthcare and a long and short in IT. Our long models focus on value factors and the short models utilize momentum factors. We expect annualized performance of 300 to 400 basis points above the risk-free rate with a Sharpe ratio of 0.5. We backtested our strategy over the most recent 15-year time horizon, which covered 2 market busts and subsequent up cycles, and based our performance expectation on these results, which have been haircut to address the known upward bias in backtested results. We also tested against additional periods and markets and are confident the results described are what we expect going forward.
Primarily target 2 sectors in our portfolio construction process. We use the appropriate SP sector indices to benchmark our sector-specific performance and judge our combined long and short models against the Russell 1000. We evaluate performance on a risk-adjusted basis with careful attention to the information ratio, volatility, alpha, significance, and the maximum percentage of drawdown. And also we prioritize the information ratios and the hit ratios in the factor evaluation process. In the model building stage, we look to find factors that improve our overall risk-reward framework, especially those that perform extremely well in the IT and healthcare sectors. When considering the performance of the stock, we evaluate the portfolio results as a whole instead of measuring the success of the affiliate of an individual stock. In addition, we place a high importance on the spread between long and short. Since we are neutral in those 2 sectors, we accept a loss on the shorts if short side can improve the stability of the entire portfolio. And finally, we focus on the longer holding period for more than a month, which can help us reduce the turnover rate.
Thank you for considering the University of Denver and Daniels Investment Group. We look forward to working with you in the future.